Chapter talks about the balance sheet, one of the three key financial statements that a company provides to its investors or its shareholders. Before we get into balance sheet, let's understand what are financial statements. So, a financial statement is essentially a record of financial activities of a business, either during a particular time or at a point of time. Right? So, it could be for a particular duration or at a certain point of time in the history of the company. So, typically, as managers, financial managers, your job will not be to prepare these financial statements, but your job would be to understand these financial statements well. And that's where we come in. We are going to tell you how to read the most important financial statements, what is the most important criteria for you to judge a particular company, and make the best use of the information provided there. So let's just take a deep dive into balance sheet. So as I mentioned, it's one of the three most important financial statements that a company publishes. The other two are the statement of cash flows and the statement of profitability, which is also called the income statement. And we'll discuss those later. Today, our focus is going to be on balance sheet only. In simple terms, balance sheet is a snapshot at one point of time in the life of a business, which helps us to ascertain where the money has been put into the business and where the money has gone into the business activities. All right. There are five key components of a balance sheet from a very, very broad perspective. You have so before we get into the components, let's understand the most important equation that you will read about a balance sheet, where assets is equal to liabilities plus shareholder equity, which means assets are essentially the investments that the company has made into running the business, and liabilities and equities are the sources from which the money has come. Liabilities are typically sources such as loans or money from creditors, while equity is the money that has been put in by the shareholders of the firm or the promoters of the firm. Right? As long as you remember that, you will so for any financial manager, that's the most important step to remember, where assets is equal to liabilities plus equity, which means the asset side of the balance sheet will always be the sum of equity plus liabilities. That's why it's called a balance sheet, because it balances the two sides. Always remember that. When we look at the asset sides, there are two key components, which are called current assets and long-term assets. And on the equity and the liability side, we have three key components, which are the current liabilities, long-term liabilities, and shareholders' equity and retained earnings. And we will start looking at each of these components into detail in the subsequent slides. On this slide, we are going to talk about the features and need for the balance sheet. As far as the features of balance sheet are concerned, it's essentially a statement and not an account, which means that it doesn't have a debit and a credit side of a typical P&L or a trading account that some of your accountants would be will be very versed with. Secondly, a balance sheet is prepared at a point of time and not for a particular period. So a balance sheet which is presented on 31st March 2016 talks about the company's financial assets and liabilities on 31st March 2016. While for example, the profit and loss statement for 31st March 2016 will talk about the company's revenues, profits, costs for the period between 31st March between 1st April 2015 and 31st March 2016. But the balance sheet will talk only about the financial assets and liabilities position of the company on 31st March 2016. Thirdly, a balance sheet talks about its summary of those accounts which are not covered by the trading and P&L accounts. So the rest of the accounts or the rest of the financial transactions that are not covered on the trading and P&L account will present on the balance sheet. The next question that can come into the mind is that why do we need a balance sheet in the first place, right? So we need balance sheet for specific purposes. Firstly, you need By looking at a balance sheet, you will understand what is the value of the company's assets and how good are those assets. Because there are certain assets which are considered good, and there are certain assets which may not be that good. Similarly, on the liability side, when you look at the company's financial obligations, you will understand whether what kind of obligations that the company has. Are those obligations which can be met, or are those obligations will be difficult for the company to meet? And thirdly, I think, and most critically, by looking at a balance sheet, you can understand if the company has a long-term future or not. Because if the company's assets are more than the company's liabilities, that means that the company is solvent. That means the company has the ability to meet its future life obligations. But vice versa, where the company's liabilities are more than the assets, then there is something deeply wrong with the firm, and it may not be able to survive in the long term.